Hello everyone, this is Pooja Sri from Tirthangal Nadar College. So I am going to give you insights about the income tax law and practices, that is Unit 1, Introduction of Income Tax. So now we'll see what is the meaning of income tax. The term income tax refers to a type of a tax governments impose on income businesses and individuals within their jurisdiction generate. By laws, taxpayer must file an income tax return annually to determine their tax obligations. So income taxes are the sources of revenue for the government. So income tax plays an important role in the tax payment. So income tax authority is going to check whether the individuals have paid the taxes in a regular basis, in a correct basis. So it is the income for the governments. So if it is going to be missed, the government can take any action towards the individual. Let us see what is the main features of a tax. The main characteristic feature of a tax are as follows. Firstly, a tax is a compulsory payment to be paid by the citizens who are liable to pay it. Hence, refusal to pay a tax is a punishable offense. So here we have see that liability to pay it. So we are the citizen who are liable to pay it. As well as if we are going to refuse the payment of tax, it is going to be punishable. Again, it's an offense. So there is no direct quid pro quo between the taxpayers and the public authority. There is no difference between the higher class and lower class. So there are, but the tax rates must be differed, but not the individual has to pay the tax, not like that. We have to pay the tax, it's a compulsory. So tax levied to meet public expenditure incurred by the government in the general interest of a nation. A tax is payable regularly and periodically as determined by the tax authorities, and it is a legal correction which is being towards the income tax. Now we'll see what are the types of income tax. Firstly, direct taxes. So income tax, wealth tax, gift tax, capital gain tax, securities transaction tax, corporate tax, everything is going to come under the direct taxes. So let us see what is indirect taxes. That is comes under the indirect taxes are sales tax, goods and service tax, which is GST, and value added tax, VAT, custom duty, octroi duty, and service tax. What are the other taxes that come place? Property tax, professional tax, entertainment tax, education cess, toll tax, and registration fee. Let us see who is a assessee. As per section 2 subsection 7, an assessee is a person who is liable to pay the taxes under any provisions of Income Tax Act 1961. So assessee can also be a person with respect of whom any proceedings have been initiated or whose income has been assessed under the Income Tax Act 1961. Assessee is any person who is deemed assessee under any of the provision of this act or an assessee in default under provisions of this act. So assessee section is going to be 2 subsection 7. Assessee is an individual who is liable to pay the tax under the provisions comes under Income Tax Law and Practice or Income Tax Act 1961. Now we'll see what is assessment. Assessment is primarily a process of determining the correctness of income declared by the assessee and calculating the amount of tax payable by him, and further procedure of imposing that tax liability on that particular person. So assessment is nothing but it is a correction of income and then finding out the tax liability on that particular person. Now we'll see who is a person in income tax. As per section 2 subsection 31, person includes an individual, a Hindu undivided family which is HUF, a company, a firm, an association of person or body of individual AOP or BOI, whether incorporated or not, a local authority, and every artificial juridical person not falling within any of the preceding subclauses. Income. The definition of the income as per section 2 subsection 24 includes It's a profits and gains and dividend. Now we'll see what are the tax rates of income tax. So income tax, old regime, new regime. So previously would have been following the old regime. Now currently we are using the new regime, which is up to 2,50,000 old regime as well as new regime are nil. So after that 2,50,000 to 5 lakh, for old regime it's 5 percentage and new regime it's 5 percentage. From 5 lakh to 7 lakh 50,000 the old regime is 20 percentage, but now it's 10 percentage. From 7 lakh 50,000 rupees 1 rupees to 10 lakh, which is 20 percentage is previous thing and now it's 15 percentage. From rupees 10 lakh to 12 lakh 50,000, the old regime is 30 percentage and new regime is 20 percentage. From the previous thing, which is 12 lakh 50,001 till 15 lakh, which is 30 percentage is the old regime and new regime is the 25 percentage. So above that 15 lakhs, the old regime is 30 and currently also we are following the 30. The maximum income tax percentage is going to be 30 percentage. How to determine residential status? So we are residing in India. So we are going to calculate the income tax of the India only. So now we can know what is the residential status, how we can categorize those income of residential status of people who are going to live in India or else a citizen of India. For the purpose of income tax in India, the income tax law in India classifies taxable persons as resident, a resident not ordinarily resident, a non-resident. So these are the three categories which falls under the residential status of Indian. Residential status. If he is said to be resident, has to satisfy any one of the basic conditions. A resident taxpayer is an individual who satisfy any one of the following conditions. So the first condition will be he or she must be resides in India for minimum of 182 days in a year, which is previous year. So resided in India for at least 365 days in the immediate preceding 4 years and minimum of 60 days in a previous year. So now we'll see what is the resident but ordinary resident. If an individual qualifies as a resident, the next step is to determine if he or she resident or ordinary resident or not ordinarily resident. He'll be resident ordinary resident if he meets both of the following condition, which is first one, has been a resident of India in at least 2 out of 10 years immediately previous year. So the 10 years in the previous year they have to be here for at least 2 years, which is the count of 730 days. So secondly, he has to say he has stayed in India for at least 730 days in 7 immediate preceding years. So the first thing is 730 days in preceding 10 years, and secondly it is 730 days in 7 years. Therefore, if any individual fails to satisfy even one of the above conditions, this is called the additional condition for knowing whether he is ordinary resident or not ordinary resident. Here if he is not going to satisfy the both condition, either if he is going to satisfy one condition also, the both condition if he is satisfying, then he is called ordinary resident. If one condition is not satisfied by him from the both, he is called not ordinarily resident but not ordinarily resident. So non-resident, we have come to the conclusion with the non-resident, the residential status, and an individual satisfying neither of the conditions stated or above be an non-resident for the year. For example, if he is not being or if he is not satisfy the basic condition itself, then he is called non-resident. Now we can clearly see the chart representing the residential status, period of stay in India in the current financial year and residential status. So 182 days or more, he is called resident. Less than 182 days, either he has to satisfy the one, no, it's 365 days in previous year, previous 4 years, and 60 days minimum in the previous year. So less than that is going to be either he is called non-resident, or if he is not going to satisfy the basic condition, then he is called non-resident. Taxability. Resident. A resident will be charged tax in India on his global income, that is, income earned in India as well as income earned outside India. Non resident and not ordinary resident. The tax liability in India is restricted to the income they earned in India. They need not pay and tax in India on the foreign income. Also note that in case of the double taxation of income, where the same income is getting taxation avoidance agreement DTAA, which is double taxation avoidance agreement, that in India would have entered into with the other country in order to eliminate the possibility of paying taxes twice. The residential status of a company. If a company, Indian company, consistently maintaining their presence within the borders of India only, a foreign company can be recognized as an Indian resident solely if it has been efficiently managed within India throughout the preceding years. If a foreign company's place and of effective management was not located in India during the previous year, it is classified as the non-resident. Even if there is a slightest possibility of the foreign company being managed effectively from the outside India, it will be classified as a non-resident only. So thank you so much.